2021 has been a mixed year for electric vehicles, EV stocks. Even though Tesla has returned 51.2% year-to-date, and the Crane Shares Electric Vehicles and Future Mobility Index ETF have returned 23.8%, Chinese EV companies have underperformed despite high vehicle deliveries. Despite these mixed returns, EV companies have a technological edge and are likely to gain better market shares over the next decade. Moving into another year, let's look at NIO and how their market shares could be influenced over the coming days. Watch this video to the end to know how NIO Company gets more funding. With no time wasted, let's get straight into the video. NIO is a Chinese multinational automobile manufacturer based in Shanghai that specializes in the design and development of electric vehicles. NIO Inc. designs, manufactures and distributes intelligent electric cars in China. The company sells electric SUVs with seating for 5, 6, and 7 people and smart electric sedans. It also provides energy and service packages to its customers, as well as marketing, design, and technological development operations, along with the manufacture of e-powertrains and battery packs, generating revenue through sales and after-sales. In addition to this, they also offer power stations, Power Home, a home charging solution, Power Swap, a battery swapping service, Public Charger, a public fast charging solution, Power Mobile, a mobile charging service via charging vans, Power Map, an application that provides access to a network of public chargers and their real-time information, and One Click for Power Valet service, where it offers vehicle pickup, charging, and return services. Furthermore, through its NIO service facilities and authorized third-party service centers, it offers repair, maintenance, and bodywork services. NIO from the outside looks like a great buy, keeping in mind that EVs are going to dominate the automobile segment by the end of this decade. On the other hand, NIO is going strong in the EV scene with the launch of the ET5 electric sedan on December 18, 2021. NIO, founded in 2014, had little expertise in vehicle manufacturing when it first appeared on the scene. However, NIO, better known as the Tesla of China due to its well-crafted, luxurious designs, went on to generate brisk sales. Unlike Tesla, NIO does not build its electric vehicles. Instead, they do so by partnering with the state-owned auto manufacturer. Let us get into the main question: is NIO an excellent stock to buy? The NIO stock numbers against NIO stock have a poor EPS rating of 43 out of 99 and an SMR rating of D on a grade of A to E. The EPS rating compares the company's earnings growth to its competitors. The SMR rating is a metric that combines sales growth, profit margins, and return on equity. NIO reported a lower than expected third-quarter deficit on November 10th. NIO lost 6 cents per share, although revenue increased by 117%. However, the firm forecasted lower than expected Q4 revenue due to ongoing chip shortages and production issues. According to FactSet, analysis predict NIO's losses to fall to 62 cents per share in 2021, down from 73 cents in 2020. This year's revenue is expected to increase by 124%. In the face of fierce competition, NIO was ramping up introducing new electric vehicles. It intends to release 3 new products in 2022. Among these are the ET7, the company's first electric sedan and most technologically advanced vehicle to date. NIO's ET7 will have ultra-long range and highly autonomous driving capabilities. It's scheduled to debut in China in the first quarter of 2022 and Europe by 2022. On analyzing, we can understand that US-listed shares have more than halved since their January high of 66.99. NIO's stock has reached a 52-week low. The store is trading considerably below its 50-day and 200-day moving averages. There's currently no buy point for NIO's stock. Fears of delisting caused NIO and other Chinese stocks listed in the United States to plummet in early December. Both Beijing and Washington have made actions that imply that they may bar Chinese companies from trading on US markets. NIO intends to list in Hong Kong. In general, NIO sees increased competition in the electric vehicle sector. Li Auto and XPeng, 2 other Chinese EV firms, are becoming challengers to NIO, which has a considerably bigger valuation. The relative strength line compares the stock's price performance to the general market, typically represented by the S&P 500. The Standard & Poor's 500, abbreviated as the S&P 500, is a stock market index that tracks the performance of 500 significant businesses listed on U.S. stock exchanges. The relative strength line for NIO stock has a considerable lag. For most of 2020, it rose substantially. A rising RS line indicates that a stock outperforms the S&P 500 index. Investors Business Daily is a daily newspaper and website in the United States that focuses on the stock market, international business, finance, and economics. The stock receives a poor IBD composite rating of 43 out of 99. The rating incorporates critical fundamental and technical variables into a single score. NIO has an RS rating of 16, indicating that it has outperformed only 16% of all stocks over the last year. The accumulation distribution rating of NIO is D-, reflecting moderate selling by large investors over the previous 13 weeks. 867 funds held shares as of September. According to the IBD stock checkup tool, NIO stock has 0 quarters of increased fund ownership. Let us look at the positives of NIO. According to IHS Markit, global EV sales will increase by 70% by 2021. Analysts believe that the worldwide semiconductor scarcity may anticipate an EV battery crisis. NIO was affected by the chip problem, as were Tesla, Volkswagen, General Motors, and Ford. NIO's growth drivers include new and forthcoming EVs. Meanwhile, battery services are critical to the company's revenue strategy. NIO has a unique subscription strategy for batteries. In essence, the automobile and battery are sold separately. Users can purchase NIO EVs without batteries at a reduced price and rent batteries for a monthly cost. They can also replace automobile batteries depending on their need. NIO announced a massive expansion of battery swap stations in July. It has now performed 5.3 million battery swaps, increasing 2.9 million in July. It has carried battery swapping to Norway, posing a new challenge to Tesla. These measures are most likely to increase their sales and after-sale revenue, which could, in turn, improve their valuation. NIO Inc. has received numerous funding in the recent past. NIO, a Chinese electric car startup, has received a $1 billion investment from a group of state-owned enterprises and Hefei in exchange for agreeing to establish headquarters in the city's economic development hotspot and giving up an interest in one of its business units. NIO's holding firm would get 7 billion yuan, or $1 billion, from investors. NIO would transfer its core China operations and assets, including vehicle R&D, supply chain, and power division, to NIO China, a subsidiary of the holding company. NIO's parent business will also invest in NIO China. In the end, investors would own 24.1% of NIO China, while NIO will own 75.9% of the controlling stock interest in the business. Business and future expansions. According to NIO CEO William Li, fully electric and hybrid EVs would account for 90% of new car sales in China by 2030. That would increase from around 10% in March, indicating plenty of room for growth. In 2022, NIO will launch 3 new EVs, including the ET7 and ET5 electric sedans. The famous Chinese business already produces 3 luxury electric SUVs, the ES8, ES6, and EC6. NIO is extending its operations outside of China while expanding its capacity in China. The ES8 is available in Norway. In 2022, it intends to market the forthcoming ET7 in Norway and Germany. On December 18th, during NIO Day 2021, the Shanghai-based automaker pledged to grow in Germany, the Netherlands, Sweden, and Denmark. NIO aspires to be present in 25 countries by 2025. On summarizing, are NIO stocks a good buy? Fundamentally, NIO's financial situation improved after debt and liquidity concerns weighed on the stock. It has drastically reduced losses while providing massive top-line growth. There's more excellent room for growth with an expanded car selection, expansion in Europe, and battery breakthroughs. However, the EV battles are heating up. The chip supply constraint will be a headwind for NIO in the short future. Longer-term battery supplies may pose an even more significant challenge to EV stocks as a whole. NIO stock has reached a new low and does not currently have a buy point. However, it's a potential and high-growth EV stock, but it does not come into the category of attractive stocks to purchase. Okay, so that's all we've got for you on NIO stock analysis. We hope you enjoyed the video. If you did like the video, don't forget to hit the like button. Let us know how you feel about buying NIO stock in the comments. So don't forget to subscribe and hit the bell icon never to miss an update. See you soon with another video. Adios until then.